Welcome to The Explainer. Today, we're tackling a silent killer in the corporate world, debt versus equity.
What actually destroys massive companies when the stock market and economy inevitably take a hit? Let's dive in.
It's all about funding. See, equity means sharing the business risk, while debt means strict, mandatory repayment. With equity, a struggling business doesn't owe mandatory interest to its shareholders. You literally just share the losses. But debt is ruthless. The bank demands its interest payment, even if you make absolutely zero profit. Now, many classes teach this dangerous myth that your debt-to-equity ratio should ideally be 2-to-1.
Why? Well, companies love debt because it artificially inflates their return on equity during those sweet boom times.
Swap 50 rupees of equity for debt, pay some interest, and suddenly profits are concentrated on less capital.
Boom! That creates a highly deceptive 28% return on equity, making the company look incredibly attractive.
But this whole financial illusion completely shatters the exact moment the economy slows down and revenues drop.
During tough times, shareholder dividends can easily be paused, but bank interest payments? Yeah, those never stop.
Paying fixed interest during consecutive loss-making years will rapidly bankrupt what were otherwise perfectly good companies.
So, if that academic 2-to-1 rule is a total trap, what's the actual ideal ratio for us?
For a truly resilient business, the ideal debt-to-equity ratio isn't 2-to-1. It's literally 0.
Just look at massive wealth creators like Page Industries. They operate with practically zero debt.
Zero-debt companies effortlessly survive deep slowdowns because mandatory bank payments don't suffocate them when sales drop.
But wait, is there ever a scenario where this golden rule of zero debt just completely fails?
Actually, yes. Banks and non-banking financial companies are the sole exceptions to this strict zero-debt rule.
Think about it. A bank's entire business model literally relies on taking customer deposits as debt.
So applying the debt-to-equity ratio to financial institutions gives you completely useless data. Just don't do it.
Always follow this 3-step safety check. Evaluate the ratio, aim for 0, and exclude financial institutions entirely. Go check the debt levels of your favorite portfolio investments right now. Are they secretly drowning?